Well, let me begin by welcoming everybody. Thanks for being with us for today's webinar. We're going to be talking about the Secure Act 2.0 and some important takeaways for you to learn from the details that you can maybe apply to your own financial planning considerations as well. I'm Chris Boyd, and I'll be hosting the program. We will be recording today's program. And so if you choose to ask a question or your participation will imply that you are consenting to being recorded. As you may know, we do quarterly webinars for our clients. This webinar we have opened up to the public as well. The themes of our webinars, we do 2 different quarterly webinars each quarter. This one is more on financial planning related topics, and we do another one about 6 weeks later in the first month of each quarter related to the market and economic outlook. So feel free to join us for future webinars, and for our clients, we do send out notification for your participation along with posting information on our website as to when those will be available. So today's webinar is the 5 most important takeaways of the Secure Act 2.0. Our agenda today is going to cover a variety of things. Before I go into that, I want to just remind everybody that as a compliance issue, we will have some compliance literature at the end of one of the last slides. But for your information, opinions are subject to change, though information has been derived from sources thought to be reliable. Our content is informational and not intended as advice. Speak with us or your financial or legal or tax advisor about what strategies make sense for your circumstances. We have the detailed disclosure at the end of the presentation. You may ask questions throughout the presentation, either by the question Q&A button. There's a chat feature as well. Or at the end, if you'd like to raise your hand, we can unmute your line so you can ask a question verbally. This webinar will be posted on our website and YouTube channel later today. So, but that being said, in fast-changing times, do tune in to our podcast and radio show because things change, and we may want to be talking about that and keep you up to date that way. As far as our agenda today, we've got a little bit about the Secure Act 2.0, some of the history behind that with the Secure Act. We're going to additionally talk about required minimum distributions, catch-up provisions, Roth considerations, 529 plans, and qualified charitable distributions, in addition to some additional strategy ideas for you, and certainly an opportunity at the end for you to ask questions. Joining me today are members of our team, our investment advisor team at Asset Management Resources. Investment advisory representatives Jeff Tamaning and Jeff Perry, along with Scott Birmingham, our lead financial planner and chief compliance officer, along with myself. So let me jump right in and let's begin to talk about the Secure Act 2.0. This did get signed into law at the very end of 2022 as part of the Consolidated Appropriations Act of 2023, I guess. Among the things that were coming out of this is an increase in the age of retirees requirement for distributions, the RMDs. They will talk about the details of that momentarily. In addition, increased amounts for catch-up provisions for people participating in work plans. There are some details there. For younger people, there can be details that have helped people to save and pay off college debt. We won't get into too many of those details today. There are additional features that it makes it easier to move accounts from one employer plan to another employer plan, as well as enables savings for emergency within retirement accounts. Before we begin, it can be helpful to review some of the details that came about from the original Secure Act a couple of years back. If you recall, this particular change that was kind of monumental, it terminated the broad availability of the stretch IRA. So when people inherit an IRA, there had been the ability to take that IRA with distributions over a lifetime. Now there are limited examples of that. For people who are, or for inheritors that are entities, estate, for example, there's a limit to a 5-year payout distribution. For people primarily, there are 10 years to distribute, and we'll talk a little bit about some of these details. And with a few exceptions, most people no longer have the stretch IRA option, but there are a few exceptions. Among those is a surviving spouse. So spouses do have, when they inherit an IRA, do have retain the ability to have a lifetime for that stretch IRA for the distribution. They're not limited to the 10 years. Minor children of a retiree who is subject to the required distributions do have the stretch benefit until they reach the age of majority, at which point they then are required to have a 10-year distribution clock. Keep in mind, this is not applicable to grandchildren. This is only for your children, for retirees. There are some instances where people who have chronically ill conditions or are disabled individuals, they may take a distribution over a stretch, over a lifetime. However, keep in mind that these are very difficult hurdles. Think in terms of Social Security, for example, very difficult to be eligible for Social Security benefits as a disabled person. These are similar kinds of very restrictive, significant considerations that the IRS imposes here. Now, there are a few individuals that can still take a 10-year distribution, a stretch distribution that are outside of a surviving spouse, such as maybe siblings, as an example. If you have a beneficiary who is 10 years younger or not more than 10 years younger or older, they can be older than you, they would get the benefit of a distribution over a lifetime, a stretch distribution. So there are several ways in which you can still participate, but it's fewer than we'd like, and most people from here forward are not benefiting from the stretch IRA and have either a 5 or a 10-year time horizon. This year, last year, there was some clarification by the IRS as to how it works when we have a 10-year distribution. Originally, when this came about, it was perceived that simply one had to take the distribution between years 1 and 10. And that after the 10th year, as long as the IRA had been distributed, there were no more requirements each year. It was optional whether one took the money annually or took it all in 1 year or at the beginning or the end or whatever. As it turns out, there are some clarifications about this. And if someone has the IRA owner before their death, if they have been subject to the required beginning date, so they've started their RMDs, then the inheritor of that IRA, during their 10-year distribution period, if they haven't distributed the entirety of the IRA, they are required to take an annual distribution similar to the stretch calculations. So keep in mind that people who have died, this for an example, if someone died at 70 before their required distribution date, the recipient of that IRA, the inherited party, if it's an individual, would have 10 years to take it out, and they would not have an annual distribution requirement. But if that person died, let's say at 75, after the required beginning date, they're already taking their distribution requirements, then the recipient, the inheritor of the IRA, does have not only to take the money out within the 10 years, but let's say in years 1 through 9, they would also have a distribution requirement to be fulfilled. Hope that's clear. It's a little confusing. In any case, let's jump into some of the details regarding the Secure Act 2.0 and changes and strategies to employ. To get us started with that, Scott Birmingham will begin.
Thanks, Chris. So just when you got used to the idea that your required minimum distributions were adjusted from age 70.5 to 72, we are getting a bump up in 2023. So the age in which you must start distributions has been changed to age 73. Further in this new act is beginning in 2033, that's going to be changed from 73 to 75. So I have a little cheat sheet here at the bottom. If you're born in 1950 or earlier, it's age 72. If you're born from 51 to 59, it's age 73. And for myself, born 1960 or later, it's age 75. What does this mean to you? Well, you've got a little more flexibility in planning for your distributions. If you don't have to typically take your distributions, if you're not taking money out of your retirement accounts already, and you can actually delay it, well, then you've got a little more time on your hands. That might affect how you allocate your money, may give you a little more time to plan around tax planning, because for most folks, it's going to give a little boost to their taxes if they take additional money out. Penalties for required minimum distributions. So it used to be extremely hefty. If you failed to take your minimum distributions out or a portion of it, you would be penalized 50% on the amount not taken. So the change that's kicked in, it's going down from 50% down to 25%. If you click, there we go. If you actually take it out in a timely manner and you make that correction, you can get that reduced from 25% down to 10%. So say, for example, your required minimum distributions for last year was $20,000. Just say you failed to take the whole thing, which I've seen before. In the past, you would pay a $10,000 penalty on that $20,000. Now it would be a $5,000 penalty on that $20,000. And if you were to correct this within a 2-year period, you get it down to $2,000. So if you were to take the money, you were supposed to take the money out by the end of December 31st, 2022. If you make that correction by December 31st of 2024, you can get that lower 10% penalty feature. Still, no one wants to pay that, but it's much less stiff than the previous strict 50%, which was quite high. Here's kind of a unique rule that I think most people don't know about. So when you think of a Roth IRA, you think of the distributions as tax-free, and you can just let the thing grow. If you have a Roth 401k account, though, you were required to take required minimum distributions out. Starting in 2024, so not this year, starting in 2024, that is no longer the case. So you do not have to make distributions from your Roth 401k. But since this doesn't kick into 2024, one of the solutions is to roll the Roth portion of your 401k out to your Roth IRA, which does not require distributions. But there's a little caveat there. So if you have an individual Roth IRA and you're opening it up, make a contribution, you cannot take out the earnings tax-free for 5 years. Similarly, if you were to move your Roth 401k to a new Roth IRA, that 5-year window comes into play as well for the earnings. If you had your Roth IRA open for, say, 3 years already, and you move the Roth 401k over to the Roth IRA, well, then you have 2 more years. But it's just something to keep in mind as far as the earnings and the tax-free feature of it. But definitely something to consider and look at every year.
So that might be an argument, Scott, to encourage people to at least have a Roth IRA before they might someday need it to start that clock of the 5-year clock ticking, huh?
Yes, open the Roth IRA. Unfortunately, some people are limited on contributing to the Roth IRA, so that kind of still hampers you, same thing. So it has to be open and contributed to, but there are income limits, but it's something we can talk to you about. This one, section 327 of Secure Act 2.0, I'll read what it says. Allows a surviving spouse to elect to be treated as the deceased employee for purposes of required minimum distribution rules. What does that mean? Well, I had to research that for quite a while. And I'm going to give you an example because it is definitely not clear. So leaving a retirement plan, IRA, 401k, to a spouse or non-spouse has its unique set of rules, which Chris talked about a little bit before, on when you need to take the money out, how quickly it must be taken out, and things like, did the spouse already start making distributions? All those things affect the rules. So in this example, it gives you a little more flexibility because I'm talking about a couple where there's an age disparity. One person is 65, one person is 70. So let me give you the current rules and then explain how it affects the new rules. So in this example, Faith, who is the surviving spouse, is younger than Tim. Let's assume he passes away this year at 65. So in 2023, Faith could roll over Tim's IRA into her own IRA and then begin her distributions in 3 years. So in 3 years, Faith would be 73, so she'd have to take the money out. Option 2, she could choose to remain a beneficiary of Tim's IRA, delay the distributions until Tim would have reached 73, so that'd be 8 years. But the money coming out would be based on Tim's age. So Tim's age would be 78. The older you are, the higher the amount you must take out.
That would be based on Faith's age in that scenario. Sorry. Because she'll be 78. Tim is just becoming 73 at that
73.
point.
Thank you. Thank you. The new rule allows Faith to be treated as if she were Tim. What does that mean? The requirement distributions could be delayed for 8 years, but they would be based on Tim's younger age. So you're playing with a couple different things. You're playing with how long you can delay taking the money out. And then the money will be based, well, the distribution will be based on ages and tables. So the younger you are, the smaller the distribution. The older you are, the larger distribution. So there's a couple of ways to look at it as far as choices. You know, again, it depends what are the ages of everybody. If everybody's got a disparity like 70, 65, then you've got a few things to decide on.
Okay.
And lastly, this is kind of a no change. So as Chris mentioned, the 10-year rule for an inherited IRA for a non-spouse, the previous page we were talking about spouses, it is required to continually liquidate the account by the end of the 10th year. So whether it's you take it year 1, year 10, or typically most folks will take it over the stretch of 10 years so they can essentially spread out the taxes on it. But that's kind of a no change.
Okay. I'll pick up here as well. There are some changes as it relates to catch-up contributions. So for employees who are participating in work plans, certain work plans, and for people who participate in IRAs, let's just go through an example. Presently, if you are 50 and over, you get to add some additional amounts to your retirement plans. So if you're an IRA, the current amount that you can contribute to your IRA is $6,500. But if you're 50 and over, you can add $1,000 more. If you're in a 401k plan or a 403b plan, the amount that you can salary defer is $22,500. Again, assuming you have salary of that amount or more. There's requirements there as well. But the maximum you could do would be $22,500. But if you're over 50, there's an additional, they call it a catch-up amount of $7,500. Simple IRAs, $15,500 plus the additional $3,500 if you're over 50. Well, the Secure Act 2.0 has thrown a little bit of a caveat into some of these, or the numbers change a little bit. So starting in 2024, the amounts will be indexed, this $1,000 figure will be indexed for inflation in $100 increments. For work plans like a 401k and such, for people in their early 60s, 60 to 63, starting in 2025, there will be an additional catch-up opportunity of as much as 150% of the regular catch-up amount. So in that case, presently that's $7,500, 150% of that, although that will be adjusted for inflation. For the simple IRA, it is in 2025, it is the greater of 10,000 or 150% of the $3,500 adjusted for inflation. So in certain pockets of opportunity, there, circumstances, there's going to be an opportunity for increased catch-up contributions. Jeff, Tamani?
Hey, I get to unmute myself. All right. Let me tell you first. FYI, SECURE is an acronym for Setting Every Community Up for Retirement Enhancement. There are several Roth-related changes we're going to talk about here. This one here is on designated Roth accounts, DRAs, beginning next year in 2024. I do urge you all to pay close attention to the effective dates throughout our presentation because they're all over the place. We have some this year, some actually retroactive back to 2020, some that happened in 25, others in 26, all the way out to 2033. This one beginning next year says no more required minimum distributions for designated Roth accounts. Now that's employer plan Roth accounts like a Roth 401k, a Roth 403b, or a Roth 457 plan. When you read designated Roth accounts, that's what it means. The plan, meaning employer sponsored Roth accounts. Historically, even though Roth IRAs haven't been subject to RMDs during an individual's lifetime, plan Roths, plan 401ks, for instance, have been. They won't beginning next year. And one reason that is important for us to understand is up until now, and even maybe through the end of this year, moving money from a plan Roth to a Roth IRA made sense for almost everyone who was approaching RMD age. Because, hey, why take money forcibly from an account that's growing tax-free when you don't have to, right? Let the money grow tax-free for as long as you can. And that meant unless there was a significant reason to leave money in the Roth 401k versus moving it into a Roth IRA, you're going to make that Roth roll over. It was almost a no-brainer for most people. But now, however, that decision looks a lot more like the traditional 401k to traditional IRA rollover decision. So it's really important to be able to look at these decisions and indicate why we're doing it. Like any transfer, we should be analyzing investment options, looking at whether there are different distribution restrictions, looking at things like fees, et cetera. There are advantages to Roth IRAs versus plan Roth accounts. And here are a few instances when it makes sense to execute a plan Roth to Roth IRA rollover. One of them is if you don't have a qualified distribution, plan Roth distributions are pro rata. So if you had $10,000 of deferrals or contributions into the plan Roth, and the account was worth $30,000, then 1/3 of everything in there is a contribution, but 2/3 are earnings. If I took a distribution of, say, $10,000 from a Roth 401k and it wasn't qualified, I'm going to get 1/3 contributions and 2/3 earnings of that $10,000. But if the same distribution came from a Roth IRA, Roth IRAs have what are known as ordering rules, where the first money out happens to be contributions, meaning I could take the same $10,000 distribution from my Roth IRA and it would be all contributions. And because it's contributions, that would be tax and penalty free at any age and for any reason. So that's a benefit of the Roth IRA. There's also one Roth IRA clock. I think Scott mentioned this earlier. Only one Roth IRA clock for all Roth IRAs to determine qualified distribution status. By contrast, if you had, let's say, 2 or 3 different jobs, different Roth 401ks, each of those respective Roth 401ks is going to have its own 5-year clock to determine the qualified distributions. Also, just note that even with a plan Roth 401k after death of the owner, that money typically makes its way to a Roth IRA. And if there's never been a Roth IRA before, even if the distribution from the plan is qualified, even if you have 5 years and 59.5, let's say in your plan, when the money goes to the Roth, if that's the first Roth money ever, then the new 5-year clock starts on that Roth IRA. So there are some still advantages to the Roth IRA you want to be aware of. Next slide, Chris. Beginning this year, you can have Roth Simple and Roth SEP accounts. That is the tax rule. That's the legislation. However, not all financial institutions or custodians today are ready for you to go to and set up a Roth Simple or Roth SEP account. At least not at this point, at the time of this particular webinar. Most still have to update their own paperwork and processes, and the IRS is required to determine what an election is going to look like in the Roth Simple or Roth SEP. And while it will probably look a lot like making a 401k Roth election, you may not be able to go to your employer and say, hey, I heard about these new things on that webinar with asset management resources. Hey, can you show me the account paperwork? They probably don't have it yet, but hopefully they will soon. As we look into other Roth provisions, there's another one here where additional employer contributions are eligible for the Roth. This includes matching, it includes profit sharing, so-called non-elective contributions where the employer sticks it in there for you, but only if they are not subject to a vesting schedule. So the employer contributions must be non-forfeitable. And the way that I read that in the act is that there's still going to be a lot determined by IRS regulations over time, but the way it reads that is someone would only be able to use this Roth election if there was a vesting schedule after they had worked long enough to fully be vested and have that fully vested status. Next slide, Chris, please. Going forward, beginning next year, those with higher income on average than the typical American is going to be required to make their catch-up contributions. That's those catch-up contributions for individuals 50 or older in a Roth plan. So a Roth 401k, a Roth 403b, a Roth 457 government plan, if they had wages from that employer in the prior year of more than $145,000, it does say wages in the act. It's very specific about that. My reading of this, at least for now, is individuals who are self-employed, who are treated as self-employed because they don't have wages, they won't be subject to the requirement. So someone with $146,000 of wages in 2023 would not be able to make a pre-tax catch-up contribution next year to the same employer. But someone who made $100 million, if they were self-employed, they would be able to make those pre-tax contribution. Again, that's because it says wages in the act. Another thing worth noting in the act, in the Secure Act 2.0, the provision says the plan of the employer, not a plan, not wages. It talks about for the employer. So let's say that you work this year from January to August, made $150,000. So that's more than the $145,000. But in August, you changed jobs and went to another employer. And for the rest of the year, you only made $60,000 only from August through December. Well, because you only earned $60,000 from that employer this year, presumably next year, they would still be able to make the pre-tax catch-up contribution. So in other words, it looks at your income, meaning your wages, that is from the employer. A common question could be, what if you're 50 or older and you can't make a Roth catch-up because the plan doesn't have a Roth option? One of my friends came up with this. He said, the Roth option for an employer is like the leather seats on a car. You can go in and you can buy the car and you can take the regular seats, or you can go in and buy the car with the fancy leather seats, but you can't go buy the leather seats without the car. Not all plans have a Roth option. You can get the Roth option with the pre-tax, but you can't just get the Roth option alone. If the plan doesn't have a Roth option and there is an individual who would have to make the contributions to a Roth account because they're over 50, they're eligible for the catch-up, but they make over $145,000. The catch-up rules in totality don't apply to that plan anymore. And so what that means is no one gets to make a catch-up contribution, whether they had more or less than $145,000. And they're saying, the IRS is saying, if one person has to, but they can't, though nobody gets to do it. So employers need to take a look at what options are available. Next slide. Just a few last things on Roth provisions regarding the 401ks. Previously, employer 401k contributions had to be pre-tax. As an employee, even if you made 401k contributions, your employer contribution, which could have been profit sharing or matching, had to be pre-tax. And now employers can allow employees to decide whether to take the match or non-elective contributions as Roth or pre-tax. So the employer may deduct the Roth contributions, the employee would take the Roth contributions as income. Another thing about Roth provisions in the plan, but it has to do with education 529 plans. So I'm just going to hand it over to Jeff Perry, who's going to talk to you a little about that.
Great, thanks, Jeff. And we are going to shift a little bit. We're going to come back to Roth by the end of my presentation here. But 529, so it's a section of the law that you may or may not heard of. We're talking about ways to save for college for your children, for your grandchildren. So they're tax advantage investment accounts that you can use for selected beneficiaries. Like myself, we have a granddaughter. We're investing into a 529 each month. So when she's ready to go to college, hopefully we have enough money saved up for her. And these accounts, when you contribute it, you add in after-tax money, no deduction for making contributions to them, generally speaking. Some states have some deductibility laws, but generally they're not deductible. But the benefit is when the funds are used for education at the end of this, they are coming out of the 529 tax-free. And it's not just college. Most people think of a 529 for going to college, but they can be used now for K through 12 tuition to a private school, colleges, as I said, or other approved institutions, things like technical training, certain types of training for licenses. It's a broad definition of education, and it can even be used for certain types of expenses that are under the IRS rules. You know, you can't like put the meal plan on your 529, but if it's books and materials and other things like that, the definition of the 529 and expenses that are allowable is pretty broad. So generally speaking, people who are saving for college for a child or a grandchild love the idea of a 529, but there's been some concerns over the years. So Chris, can you go to the next slide, please? So here's the problem, right? You save all this money like we do every month. What happens if our granddaughter doesn't go to college? Is this money all locked up in this 529? That's a concern of a lot of people. They want to save, but let's face it, college isn't right for every child, or every child decides not to go to college, or maybe you put too much in. Maybe we save and save and save for our granddaughter's 529, in her 529, and she gets a scholarship, full ride. This money is locked up there. There have been opportunities to change beneficiaries, or you could withdraw the funds and pay some income taxes and maybe some penalties. But even the people who are very excited about saving for college expenses for their loved ones have had this kind of fear or hesitation to really load up a 529, because what if the money's not used? Next slide, Chris. So Secure 2.0 really gave us an exciting opportunity to go ahead and load this right up. Because if you have unused 529s under certain rules that we'll talk about, in the 529 account. So you load up the 529 and either the child doesn't go to college or maybe they don't use it all. Under the provisions of Secure 2.0, you can transfer up to $35,000 into a Roth IRA for the beneficiary. Now, when this first started coming in the news, some people thought that the donor, there was some kind of stories that weren't totally accurate. It doesn't mean you get the money back as the donor. It means that the money can go from the 529, the unused money, into an IRA, a Roth IRA for the beneficiary or that child. Now, as any new law, there's plenty of rules, basic rules that limit your ability to do so. So if there's money left over, you can roll the money into a Roth IRA, but it has to be in the same name as the beneficiary. In our case, our granddaughter, she doesn't use all the money. There's up to $35,000 left over. We have the ability for a maximum lifetime transfer from the 529 funds into a Roth account for her. A couple of additional rules. The 529 must have been maintained for 15 years prior to the IRA rollover. And a side note here that's not on the screen, you don't have to roll over the money from the 529 to the Roth IRA the day that they're done with college. You can wait for this 15 years to happen, but it shows that it's prudent, if this is a strategy that someday you might want to take advantage of, is to open that Roth IRA early. For example, if you just had a child or a grandchild born, get that account open now so you get that 15-year clock ticking. And the money that you roll over is limited to contributions made more than 5 years before that transfer. So typical case, you open an account when the child is born or shortly thereafter. You're contributing. You stop contributing maybe when they start college. They go to college for 4 years, for example. 1 year later, you could roll over, because you're meeting the criteria of the rules, you could roll over up to $35,000 to the beneficiary, to that child, up to $35,000. And of course, a couple additional rules at the bottom of the screen. The IRA rollover will count towards the limits of a Roth and traditional IRA for the beneficiary. They can't put more money into the Roth in any given year than the rules allow. And when you're rolling that money over, this additional money that's still in the 529, when you're rolling it into a Roth IRA for your beneficiary, if you meet all these other criteria, that beneficiary must have earned income, just like a regular Roth, of at least equal to the amount that you're transferring in any given year. So your beneficiary doesn't use all the money in the IRA. They're done, you meet the 15 and 5-year requirements. They're out of school, they get a job, and they earn $50,000 the first year. You can roll over that year, the maximum amount at that time in any 1 year, because you meet the other rules and now your beneficiary has earned income. So it might take you a few years to get up to this $35,000, but if you meet all those criteria, you can take those that excess money and set your beneficiary up. Not only did you pay for their college, but now you're setting them up to have a great start in their retirement. And there's one more section that I want to talk about, one more opportunity that might be right for some people. Chris, can you? So I'm going to put the caveat in there because I'm not a tax expert, but with the guidance of a tax expert, your CPA, for example, you have the ability, if you have the funds to do this, you can super fund a 529 with a one-time contribution of 5 times the annual gift limit, or $85,000 for 2023. What do I mean by this? Right now, in 2023, the annual gift limit to any individual is $17,000. This provision allows you to take 5 times that limit, so 17,000 times 5, $85,000, and make a single contribution into a 529. And if you think about it, if you had a child or grandchild born this year, last year, within the last few years, you could do one, and you have the money to do this. I know it's not applicable for all of us, but if you have the money to do this, you can make a single $85,000 contribution when the child is young. So back to the previous rules. So that money grows, it's invested. That money grows for presumably 18 years if it's a newborn, or at least 15 years under the rule, and the money was obviously contributed before the 5-year rule. And this money, think about the compounding interest of this money growing, $85,000 for 18 years invested. So this single contribution, you could likely, depending on what school they pick, of course, I mean, if they're picking a college that it's $100,000 a year, it's not going to make it all. But, you know, for the average tuition and expenses for a state school or many private schools, you can make this single contribution, and that might actually be enough with compounding interest to fund their entire undergraduate studies, and the leftover money can be used to create a Roth IRA for your child or grandchild. If you have the money and you're thinking this might be a good idea, this Roth option is the Roth provisions added to the 529 just make this a very attractive option to consider if it's right for you.
Excellent. Jeff, we have a question before we move on that I'd like to have you have the opportunity to address, because it may offer some clarification for people who have any confusion.
Right.
Susan asks, does rolling a 529 into a Roth have the same effect on financial aid as a 529 would have? So, you know, I think the timing of when this would happen might be
Right.
relevant to talk about.
Right. So you wouldn't, so the short answer is no. And the reason is you wouldn't consider rolling the 529 funds into a Roth IRA until the child had completed their education. For example, if you had excess monies in the Roth IRA after undergrad and the child was done, you might at that point consider going into a Roth IRA with the additional money, and then there's no financial aid in the future. If your child is applying for graduate school, you might leave the money in there to use it for graduate school, but I can't think of a scenario, and Chris, correct me if you can think of one, that you'd be rolling the money into the Roth IRA that it would have any negative consequence for any financial assistance. Because you,
No, I
in
don't
essence,
believe so. I just
you'd be
think you probably
done.
wouldn't be likely to do it until after the student had completed their college, you know, expenses. That'd be likely to be after that point that you'd consider that conversion.
And one more, just going back to all the rules, and I know there's a lot of rules. So if you're thinking of doing this, reach out to us and we'll go through your specifics to see if it makes sense for you individually. But if you remember, one of the rules that I discussed is that you cannot roll the excess funds from the 529 to the Roth IRA until the beneficiary, the child who's an adult now, has earned income equal to the amount that you're going to roll over in any year. So in essence, they'd be working, which means they'd likely be done with their educational experience. But it's a good question.
Jeff Tomaning, you were going to add a tidbit, I think. Did that get covered?
Well, it was a little bit different, but I do think it does stress the importance of overall long-term financial planning, because you know, you have the 529, you have the option within the 529 to have it go up and down the family tree. And maybe if you were thinking of having it go to the next generation, that may or may not be the best thing, because you could, in essence, just move it to, you know, the student's Roth IRA once he or she has that earned income, and that might be a better place for it than for that particular student's offspring in the future, because it's going to be the retirement account, which will not show up on the FAFSA as opposed to, or on the financial aid form, as opposed to how the 529 plan would, even though it was rolled, you know, to the next generation. So, but again, that's something that's come a more long-term financial planning, but just something worth considering.
And just off of Jeff's comments, it also matters if you're considering 529 plans generally and the effect that they may or may not have on financial aid opportunities. It matters who's the donor of the 529, because they're looked at differently if it's the parent or the grandparent or the relationship. So there's a lot to it. Well, there's a lot to everything that's Secure 2.0, which is obvious from our presentation, but there's a lot to the 529s. The best thing about this additional option in 2.0 is that go back to my original comments, a lot of people, when they think about a 529, they want to go all in. They'd love to have enough money for all of the education, at least for the undergrad, for the beneficiary, but many people were hesitant because they'd either have to pay taxes to get out the excess, or they felt like they might have to give it to a different beneficiary. But now this option is the most attractive to me, and not to talk about my granddaughter like I like to all the time, but I would just love the thought of having too much money in our 529 and say, congratulations on your first job. And, guess what? You have a retirement account and it's got $10,000 or $35,000 or whatever it is in it. It's just another way to help out your beneficiary off to a great start in their life.
Okay, great stuff. Thank you, both, everyone. Let's hit our fifth point. And this relates to qualified charitable distributions. This is not new to the Secure Act 2.0, but just to reiterate, if you're not taking advantage of this and you're eligible to, you're missing a great tax benefit. A show of hands, who likes to pay taxes? I'm envisioning nobody's hand went up. Here's an opportunity where you can avoid tax. And essentially, if you're someone who is 70 and a half or older, so unlike some of the discussions we've talked about where the required beginning date has moved later, this is still 70 and a half, the old age that it used to be when you had to start your RMDs. So if you're of that age, 70 and a half or older, and you like to give to charity, you should be entertaining the use of a qualified charitable distribution as the means by which you pay charitable entities. Essentially, you can take money that's IRA money, pre-tax money, and pay it toward your charitable interest, whether it's a church, a charity, a hospital, an alma mater, whatever that may be. You can have those funds be paid to them. Now, as a nonprofit, they don't pay tax on that receipt of that money that you provided. So essentially, you can take money that's pre-tax money and gift it, in effect, to a charitable entity that does not pay tax on it. A great tax avoidance tool. Who doesn't like that idea? So essentially, the rules here are, by the way, in addition, this can count toward your required minimum distribution. So if you have subsequently have required distributions, you can, if you do your qualified charitable distribution earlier in the year, it can count toward your RMDs. So age 7 and a half or older, you have an IRA. You wouldn't use Roth IRA for this kind of an activity. You only want to use your traditional IRA. This does not apply for a qualified plan, a 401k. This is IRA only. And then you can essentially fill out a form with your IRA custodian, have the money go to your charitable entity. And you do have to notify your tax preparer because they're not going to know to do this unless you tell them. So it's not identified on your tax forms specifically that it went to a charitable entity. So in any case, a qualified charitable distribution, if you're not using it, be sure to take a look at it for the future. Now, what does change with the Secure Act 2.0 is that starting in 2024, again, as Jeff Tamaning mentioned, there's a lot of different dates that you got to pay attention to when these happen. But 2024, there's a maximum annual amount of $100,000 presently, but that will start to be increased for inflation. So most people aren't doing $100,000 of charitable contribution from their qualified charitable distribution, but you can do as much as that in any given year, and now that will start to be inflation adjusted. Additionally, there's a one-time $50,000 amount that you can do from a qualified charitable distribution to what is called split entities, split interest entities, such as a charitable remainder trust. Keep in mind, this does not include donor advised funds. They're not eligible for this technique. So I think that's a fun one. I get excited about that. Just can see Jeff gets excited about the 529 plans. There's different tools we're getting excited about. Hope you'll take advantage of and make use of in your own planning. We do have a few additional thoughts for you that you may want to take note of. And, let's start with some review of the Tax Cut and Jobs Act. And I may get Scott involved in this conversation as well. But one of the things that you want to remember is that the Tax Cut and Jobs Act, which was the tax law passed under the Trump administration, it's temporary. It will expire at the end of 2025. So right now, when we talk about tax rates and the income bandwidth for which rates you're in, these are presently such that, for example, if you're a married filing jointly, if you have income, the portion that exceeds, $89,450, but all the way up to $190,750, that portion of your income is paying 22%. Imagine you had income of $100,000. There may be a window now, particularly for those people who have delayed RMDs. They may not have RMDs as quickly as they used to or thought they would. This may create a window for you to intentionally choose to do some Roth conversions, maybe within that tax bracket. So if you had $100,000, maybe you do another $90,000 of conversion, choose to pay the tax at the 22% rate in that scenario I was giving, because you know that in a few years, the rate of tax is going to be higher, and the bandwidth for when you get into those rates gets lower. So we're going to be shortly seeing higher taxes by virtue of the expiration of the Tax Cut and Jobs Act. And so for many people, it makes sense to think about choosing to pay taxes sooner than later, because you can choose to pay at a lower rate than you'll have to pay later on. So I don't know if I did that clearly, but Scott, we often talk to people about whether or not it makes sense to do a Roth conversion and filling in the remainder of their tax bracket, if you will, with a Roth conversion. It's not necessarily appropriate for everyone, but I just thought you might want to chime in on this a little bit.
No, I mean, we were talking about delaying RMDs, which I think kind of gives us opportunities for more Roth conversions. So it's not for everybody, but for a lot of folks, their biggest asset is, beside their home, is in retirement accounts. And when they do delay it to the RMD ages, you see kind of a big explosion in taxes. So there's those years when you retire to when you'd have to take RMD. There's opportunities for a lot of folks to, maybe I'm going to pay a little tax now, A, tax rate to lower, B, my portfolio isn't as big, put that towards a Roth conversion, which will eventually be tax-free to you. So there's more opportunities, and even though the rules are saying, you can wait longer on your RMDs, it may not make sense for a lot of folks.
Yeah, so if your IRAs are quite large, or if your IRAs are relatively small, it can make sense for you to entertain this thought of trying to fill in your tax bracket and convert money from IRA to Roth IRA, particularly if it will help prevent you from going into higher tax brackets later on. And everyone is going to be in higher tax brackets in just a few years, barring a change in your income status or whatever. So, and that's relevant to people who are near retirement, so forth. These are all considerations we want to take into account. All right, so make sure you talk to us about your financial planning as part of that discussion. Additionally, there's been some consideration of a technique called the backdoor Roth IRA. This essentially is a technique that is riddled with risks because there are, it's complex and you don't want to make a mistake in how you approach this. But it can be an opportunity for people who have an income that is greater than the allowable amount to contribute directly to an IRA, that is a Roth IRA, that they may find a way to put money into the Roth IRA. Essentially, the technique is to make a non-deductible contribution to an IRA and then convert it subsequently to a Roth IRA. The caveat is if you don't have an IRA of any kind already, this works very smoothly. If you do have an IRA, Jeff, I think, mentioned something about different rules, pro rata and so forth. Here's an instance where if you have an existing IRA, just because it's a different account doesn't count. The IRS looks at your IRAs all as one in essence. So if you make a non-deductible contribution and then try to convert it, but you also have another IRA, only a proportional amount of that conversion will be counted as non-deductible, a non-tax event in that conversion. So my point to you is get help in doing this, be very careful, but it can be a nice tool for people who have the ability to do savings or to take existing savings and move it into Roth status, but it is something to be very careful about how to do. Anybody want to add to that or contribute to any content to that conversation? No? Okay, last page here on some of these also things to consider. Oh, maybe one or two more. Jeff Perry, I think this was a slide you were going to clarify or reiterate.
Right, this came up as part of the 2.0 and generally good practice. First of all, make sure that you have beneficiaries in all your retirement accounts, not just a beneficiary, make sure you have the right beneficiary. Sometimes, especially on employer plans or IRAs, plans that last a long time, when you set them up, you name your beneficiary and that beneficiary may still be the right one, or they may not be the right one. Life happens and people pass or divorce so take a minute, check all of your beneficiaries on not only your retirement accounts, all your accounts, your life insurance. It's a good thing to do every few years just to make sure that you have the correct person or the right trust or whatever it is. And it matters more now because it has to do with if you have a designated beneficiary, meaning the person that you want to be the beneficiary of that account, it can change the distribution schedule that if they inherit it, it would be 10 years versus 5 years if the beneficiary was chosen through an estate process, meaning you had a beneficiary who passed away, you had a beneficiary not listed at all, and if it happened through the probate court and the beneficiary wasn't designated, whoever ended up with having that account as the legal beneficiary would have a shorter time period to have the assets distributed, and thus a greater tax burden in a shorter period of time. So just two quick lessons. One quick lesson, check your beneficiaries, make sure you have the right beneficiary listed, and it will make sure the person that you want gets the money, gets their inheritance, and it stays out of the probate court, and they have the advantage of a longer 10-year distribution schedule.
Yeah, it's a great point, Jeff. There's a lot of circumstances where people have sadly had their work plan go to someone they didn't intend. Let's say, for example, they intended this money to go to their kids, but some other money to go to a spouse or something. If it's not signed off on correctly, if the beneficiary isn't updated properly, or as you said, if there's been a divorce, if there's been some kind of change, those beneficiary designations need to be updated. Has this been covered fully, or is there anything else on this slide you wanted to touch on?
No, I think
Okay.
we've covered that. And one just additional comment, you might even think that you may have the actual beneficiary, on the account, but if you've been in a job for a long time or had an IRA for a long time, that bequest, that amount of money may be larger than you intended initially to give to that beneficiary. So it's just a good advice generally, not just to check your beneficiaries, but in the larger picture, check your estate plan and review that as well and make changes as your financial situation changes as well.
All right, we're wrapping up here in our review. Essentially, we've identified some various situations with Scott's comments about required minimum distributions and some of the changes of the Secure Act. We talked about catch-up contributions. Jeff Tamaning talked at length about Roth IRA. All these are retirement plans. There's a lot of changes in the Roth spectrum. The 529 plan that Jeff Perry shared, and as well the qualified distributions. These are some of the things that you want to take away as some techniques and some important changes with Secure 2.0. If you have a question, we do have an opportunity to address any questions that may come in. If you'd like to put your question in the Q&A section or the chat area, as well as if you'd like to raise your hand if you have a verbal question, we're happy to do that. Keep in mind additionally that we do have upcoming webinars that we want you to be aware of. The webinars for the economic and market outlook updates are scheduled, and they're available on our website to register, as well as our financial planning webinars. These topics will change from quarter to quarter, but you can make note of these dates if you'd like to attend and participate. At the end of our program today, we're going to have a short survey. We'd appreciate your feedback to give us insights. Additionally, if you have more questions about the webinar, we're going to make it available for people to go back and review if you want to look at it in more detail. Be aware as well, we have some disclosure information available to you, and that does include the link. If you need any more information, reach out to us. We're happy to talk to you directly. You can connect with us through our website, amrfinancial.com, as well as give us a call at 866-771-8901, or you can send us an email to clientservices@amrfinancial.com. Gentlemen, I don't see any other questions at this time. So thank you all for your participation, and great job on the content, guys. Appreciate it. And we'll be talking more about this, no doubt, on the radio. So tune in to our podcast and radio show as well. Everyone, thanks for being with us. Let us know if you have any questions about your particular situations. You can reach out to us directly. Thank you.